There's a powerful options trading technique called the risk reversal option strategy, which supercharges your returns on a trade if you're right, yet provides you a substantial margin of error if you're wrong. In this video, we explore the possibility of an upcoming bullish market move and how this option strategy can make you a 100% return in 60 days if you're right, while keeping you in surprisingly good shape with a big margin of error if you're wrong. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to have developed numerous 7 and even 8-figure per year traders. We hope you agree this is the top YouTube channel to help you grow your trading account.
Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And the traders on our desk are trained to spot opportunities that present themselves and, among other things, deploy certain option strategies to capitalize on those opportunities. And one of the greatest things about options strategies is that while they usually provide the potential for explosive returns, they can also easily be structured to give you a margin for error within which you can make money, even if a stock or even the whole market doesn't quite move the way you expected. And today we're here to teach you a strategy that is a great example of those properties. So for example, let's take a look at the SPX index over the last year, the S&P 500 index, and you'll notice that it's been in a pretty classic uptrend since October 13th, a day where the index initially sold off and then massively bounced, which many took as a technical indication of a possible bottom. And as of today, the index is still about 15% below its all-time highs. So this market has plenty of room to run upwards, even though, like in every other bull market, there are always things to worry about as far as downside risk. So it's nice to have a little bit of downside leeway if the market pulls back during the course of the trade, instead of continuing its rally, which would have been the base case of the trade. Now, in order to explain how this strategy for playing the market with a bullish bias works, we need to make sure that everyone watching the video understands how index options work. So we're going to do a really quick review of them, and then we'll jump right back into the details of the strategy itself. And so the best way to understand index options is to think of them as bets. What are known as call options pay off if an index closes above what's known as the strike price of the option on the day that option expires. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call strike price. The put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So for example, if an index closes at 40.32, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 40.75 call would expire worthless as the index didn't close above 40.75, so the call seller just pockets the premium. And the puts are the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put strike price of 40.75. But the 4,000 puts would expire worthless because the market didn't close below the 4,000 strike price. With that said, let's head back to a similar period to now, back in 2020, where for a very different reason than today, the market was bouncing off of its pandemic crash lows, which took place in mid-March of 2020. And by July 1 of that same year, it had regained much of what it lost in terms of value during the pandemic crash. But it still had a ways to go to get back to its all-time highs, which it reached right before the crash in early February. So a similar setup to today. And so let's say that you were bullish on the index at that point, believing that it was going to retake its all-time highs given the massive fiscal and monetary policy interventions going on globally at that time. And so given your bullish outlook on that day, you pulled up an options chain expiring 2 months out on August 31st, and you went ahead and bought 2 calls at the 3,300 strike price on that expiration date, which is a couple of hundred points above where the index was trading. and you simultaneously sold two puts down at 3,000, which is more than 100 points below where the market's trading. And then for protection, you went ahead and bought two of the 2,800 puts. Well, if you did that, you're entering into a modified version of what is known as the risk reversal option strategy. Now, let's break down how this works. And to clarify what's going on here, let's take a look at the opening cash flow of this trade. So let's start with the two puts that we sold at the 3,000 strike. And as you can see from the calculation, we sold them for $91.85. And because each point below 3,000 requires us to pay $100 per point when it expires, we multiply that by 100, and we sold two of them, resulting in positive cash flow of $18,370 from the puts we sold. Now, we'll subtract from that the cost of the calls up at $3,300, which, as you can see from a similar calculation, results in a cash payment by us of $68.20. And we also bought those protective puts down at $2,800 for $99.30, which, when you net it all down, results in positive cash flow of $16.20, as you can see from the calculation. And finally, we should point out that your broker will require $38,380 in capital to execute this trade, which is also its worst case scenario loss, although obviously no sensible trader would ever let the trade get that bad. And I'd also like you to focus on the fact that you've entered the trade without any cash outlay at all. And in fact, you received over $1,600, which will be important to keep in mind as we move through the rest of the example. Okay, so now let's move up in time to the day that these options expire on August 31st. And as you can see, the index not only reached its all-time high, it outright blew through it, closing at a new record high of exactly 3,500 on that day. And I know that's a weird round number for a close, but it actually happened on that day. It closed at 3,500 on the button. And so now we're in a position to put a final value on each of our options, and that's actually going to be pretty easy, as you'll see. So let's start by remembering that we received that $16.20 up front. And as you can see, the two put positions, the two short puts at 3,000 and the two long puts at 2,800, both expired worthless because the index closed far, far above their strike prices, and they only pay off if the market closes below their strike prices. So both of those puts have no value, obviously. And as for the two calls up at 3,300, well, those became very valuable because the calls that we bought pay off at $100 per point above the strike, and we bought two of them. So to calculate the value of those calls that are in the money, you take the closing price of SPX on the day the options expire, and you subtract that from the strike price of the call, and the result in this case is 200, meaning the index closed 200 points past the strike price. And so again, you multiply that by 100 for each point that the index closed above 3,300, and we bought two of them. So the final value is $40,000, which when added to the $16.20 credit that we originally got, the grand total of the profit on the trade is $41,620. Remember, we don't have to subtract that initial cost of entering the trade because there was no cost. Instead, the opening positive cash flow is added to the profit, and that would have resulted in a return of over 108% in exactly 2 months. Now, before we wrap up this lesson, I wanted to point out something really important to understand about this trade. You see, we could have been wrong, of course, about our prediction, and the index could have sold off after we entered despite our initial bullish bias. But what's important to understand is that your bias being wrong is not necessarily going to result in a loss with certain option strategies. For example, suppose that instead of rallying up to 3,500, the index had actually closed at 3,001 on expiration, so it sold off. Well, in that case, then all three options would expire worthless, right? Because the puts, again, would expire worthless because they, again, by a smaller margin this time, still expired below the closing price of the index. And of course, the calls expired far, far above the closing price. And so the calls go out worthless too. So they all go out worthless, but you still have that initial credit you received. And so that's kind of your consolation prize, if you will. And even though you were looking for a larger profit originally, most traders would settle for a small profit when their bias is outright wrong, wouldn't you? And remember, this happens at every price above 3,000 in this example, if you think about it. So you'll make money with this strategy, even if you're a little wrong on your bias. As long as you're not more than a little wrong, this strategy will work. But of course, the more right you are, the more money you'll make once these long calls get activated, as they did in this case. And so what I'd like you to take away from today's video is that with options, it's possible to enter a trade with literally no cash outflow, as it did in this case, and end up with an incredible profit if your premise is correct. But what's just as important is that even if your premise is not correct, option strategies provide you with a pretty wide leeway to be wrong and still make some profit on the trade, a luxury that literally no other trading style affords, which means you'll win more trades and build up your confidence in your trading in the process. A high win rate on your trades isn't the only goal, but it sure feels good to win a lot. To possess the knowledge of strategies that provide you with an excellent win rate is very helpful for both professional traders as well as retail traders like yourselves.
Okay, so some traders like strategies like this that can bring huge returns, but others like to make consistent monthly income. One way to do that in options is through selling covered calls, but most investors and traders don't realize that they're usually making one or more of 5 deadly mistakes with this strategy. Click on the video appearing on your screen right now to find out what all these mistakes are and if you're unknowingly crushing your returns by making these mistakes.